Hi, everyone, and welcome to the Business KPIs Masterclass with Deskera. So glad to have you here, and we hope to have a great session today and answer your questions. And we are bringing this live telecast to you from our Deskera Experience Center in Singapore. And we hope to have an interactive session today with you. So please feel free to ask questions in between. And if you have any doubts, both me and my co-host David will be more than happy to answer. David, how are you doing today? So let's jump into the Business KPIs Masterclass for today now. And so what are KPIs, right? Business KPIs is a very generic term sometimes. If you're not careful with what you are measuring or what you are tracking, then you can end up with some real weird numbers, and that is what we want to avoid. So could we have the slide on the screen, please? Thank you. Layout guy. Okay, wonderful. So, yeah, let's go to what we will cover today. And what we are going to cover today is first to understand what the KPIs are. We will look at metrics versus KPIs. So, they are not the same thing, right? KPIs are slightly different to metrics, and often we tend to confuse the two terms. So, we will understand the differences between them. Then we will look at leading and lagging indicators. Why we want to do that is because there are inputs and there are outputs. And we need to be sure that we are both forward looking with our inputs and backward looking with the output measurements. We will also take a look at 10 KPIs to track for nearly every industry. We will look at a few industry specific KPIs, and we look at some of the KPIs that are tracked by some of the fastest growing companies in the world. Okay, so let's jump into it. Now, David, when you think of the term KPIs, what comes to your mind?
I always think of key performance indicators, which is the name of it. But you know how they actually start doing measurements and stuff on certain things, like how many employees are happy, what's our profit and loss, or I guess, how many people attended an event, how many people are attending an event, what percentage of them are from this industry, that industry, something like that is what I would think of.
Right. So you wouldn't be wrong in saying that when you're talking about KPIs. But the most important thing about a KPI is that they have to be aligned with business objectives. And KPIs are then used to define your employee goals, your business goals, and align them all together. So let me give you an example, right? If there is a sales team that has got a KPI of, or rather, I wouldn't call it KPI, but I would call it metric, right? Who are tracking a metric of leads generated, correct? And that is the metric that they're treating as their KPI. Then they will be focused completely on the number of leads being generated. But if they are not looking at the quality of leads or the lead closure rate, and hence there would be it is possible that there would be a misalignment between the objectives of the organization which is interested in closure or the revenue being generated. Actually, as a business, you are more you're obviously thinking about generating revenue for the business, right? But number of leads, how many leads you are getting is not equal to the revenue that you are generating. And it is quite possible that if we are chasing the wrong number or chasing the wrong metric here, then we may end up with a lot of leads that actually don't relate to what the organization is trying to achieve, correct? And there can be a misalignment. So there has to be an alignment of KPIs with strategic goals, with business objectives, and with the employee goals as well, correct? And then these KPIs will help you in making decisions about which direction to take for your business, for your team, for your department, and so on, correct? So this is an important distinction that we need to have for KPIs, right? If you go by definition, then KPI is something that allows you to measure performance for your business. Now, these performances can be, these performance metrics could be either outcomes or inputs. So KPIs can be both. They can both be outcomes and they can both be inputs. An example is the profit the profit amount, or the gross profit that you make at the end of the year. That can be a KPI, all right, but that's an output KPI or an outcome KPI. Now, the input KPI for this could be sales generated every month, right? That is one of the input KPIs that you can also track. But yeah, I mean, this is theory, right? I mean, let's jump into some examples and let's look at examples of good and bad KPIs, and how KPIs should be structured through some examples to understand how you should set up your business KPIs. Um, David, when you take a look at this slide, which is good KPIs versus bad KPIs, right? Then which ones do you think are good KPIs to track, and which ones do you think are bad KPIs to track?
I would say probably number of leads closed in a month would be probably a good KPI, while number of leads by itself is not a good KPI. You can have tons and tons of leads, like you were mentioning earlier, and have some bad ones there as well. Customer acquisition cost, how much for a customer to be acquired, I would say would be a good KPI, I guess. While advertising expenditure by itself without anything it's related to, I guess, would you consider a bad KPI? Because if I just know how much advertising I'm spending every month or every year, but I'm not marking it or do any measurements to it, where how much customers I'm acquired, how much is the turnover ratio, how much is the staying. I would also think of like support. If support is doing a good job, what's the turnover ratio, how quickly are we resolving the issues, and then therefore how much is the customer retention would be something good. This is just stuff off the top of my head. So customer churn rate, cost of goods sold.
Right. So I think you're pretty close to the answer here. Okay. So let's look at the first example here, which is like on one side we have number of leads, and on the other side we have number of leads closed in a month. And by closed, I mean leads that were converted to paying customers. All right. So which one of these would you pick as a KPI, or which one of these would I pick as a KPI, and why? Okay. Now, one characteristic of a KPI or a business KPI is that it should be comparable over a period, right? So if you look at the KPI value for a particular period and then you compare that with the next period or the previous period, then you should have something concrete to see the progress or the movement of the KPI from that time period to another time period. All right. And if you do not see that happening as a definition of your measurement, then it is not generally a good KPI. All right. So number of leads by itself would not be a good KPI to track, or a KPI in its essence. It is a metric. The number of leads being generated, it's a metric, right? Number of leads closed in a month is comparable, right? You can compare January with February, you can compare February with March, and so on, right? It could even be number of leads generated in a month, because it's time bound. So it has to be measurable and time bound, right? So that is what differentiates a good KPI from a bad KPI. All right. Same goes for example, advertising expenditure. So even advertising expenditure per month, right? I wouldn't track that as a cost KPI. Why? Because it does not tell me, or maybe it does not align with my business objectives, which is tracking the impact on my gross profit or my overall revenue, right? Whereas if I look at customer acquisition cost, then it is both a growth KPI, and it tells me clearly that, okay, for every customer that I'm acquiring, this is the amount of money that I'm spending over a period of time. And that is something that aligns more nicely with what I am trying to achieve. Of course, KPIs are something that keep evolving over a period of time, right? and they evolve and they mature as your organizations grow. So something which may not be considered a KPI today may become a KPI tomorrow, and things or numbers or metrics that you are considering or thinking of as KPIs today, may not be good KPIs to track as your organization matures. And we will be looking at some examples to think of that, right? So number of units bought, for example, right? Now, when I say units, I mean maybe the amount of stock that you have purchased, correct? How many items you have purchased in a month. If you are tracking that as a measure of your cost, then that's not a good example of a KPI to track at all. Whereas if you're tracking cost of goods sold, then you are clearly aligning it with one of the objectives of your business, which is customer acquisition or sales, right? And you're looking at the cost of sales here, and therefore tracking cost of goods sold is a KPI that you would want to track, and not the number of purchases that you have made or the amount of purchases that you have made. All right. So, David, do you have any examples that you would want to share here, or anything that comes to your mind, or if you have any questions about any particular metric or number that you have come across and you're not sure whether you should treat it as a KPI or not?
I was just thinking, there are cases where I've seen in other businesses where they have to take in that not everyone's aligned. Sales has a KPI where they have to buy sell so much goods, but then you have the delivery and fulfillment team. They have to deliver in full and on time. Then you have production that has a KPI that says, I need to reduce costs. And sometimes these I find come in conflict. Like if I'm supposed to reduce cost, then I can do it, but I can set it up a certain way. I have to reduce it by this much percentage in order to increase my yield, for example. And if I have another part of it that says I need to deliver in full and on time, maybe after sales or after sales support, then their job is to make sure that all the goods go out quickly, on time. And they are calling production, saying, production, produce more. But then the production will say, no, that'll cause a higher cost. And then you have the sales saying, we're flooding in all the orders. If you're lucky enough, flood in all the orders as quickly as we can because we need to get this all in. And then after sales is like, but we can't deliver on time. And good old production saying, but I can't produce the margin that I want to or the cost savings. So how does someone handle the situation where aligning all the KPIs across all the different departments?
Right. That's a very good question, David. And so you have to think of the definition of KPI, that it is something that you use to align your entire organization, right? And that means aligning personnel, aligning departments with the organization's goals, right? So let's take an example. I mean, since you took an example of a manufacturing organization, right? So let's work with that example for a few minutes here, okay? Now, in a manufacturing organization, let's say that it is an organization that is at an early stage. It has just started business, maybe a couple of years down the line. They're still finding their feet. They're getting, they're establishing their brand image and their credibility in the market and so on, right? So an early stage manufacturing organization, they're still, finding suppliers. They're still, setting up their customer base and, trying to get that in place. Now, for this kind of an organization, right? Because they are at an early stage, right? What they are focused on is customer acquisition, which kind of is always the focus for any business, actually. So they will always have that as one objective. But they're also trying to build a lot of credibility in the market, right? And quality is going to be super important for them. Speed of delivery is going to be super important to them, right? Now, these will evolve with time, right? But at this stage, right, they may want to sacrifice the rate at which they might process stuff at the cost of ensuring higher quality, correct? Because that is what is going to help them build credibility in the market, right? So in such a case, right, obviously they want to increase sales, but they want to get more customers onboarded, more suppliers onboarded, and so on. So So if they have to align their KPIs, right, then the overarching KPI for the organization would be customer acquisition and revenue being generated. Right now, these are the overarching or the top level or the high level business goals that they have. Now as you start going down the department, right, I mean, as you start going into the organization, correct, you have to align these with individual KPIs, with department KPIs, correct. If the focus is super high on quality, right, then first pass yield has to be really high, right. If the focus is on speedy delivery, then also one KPI that they would want to keep a track of is first pass yield, because then if they have got a good first pass yield number, then it means that they are producing goods the first time, and it is passing the quality checks, right, and that is going to build their credibility in the market. Correct. So that will be one of the most important KPIs for them. Now all the other things, the cost for example at this point of time may not be a KPI, it's a metric that they would want to track, right. In the first few years, often young companies are not as focused on cost or profitability as much as they are on acquisition, on building credibility, on building an image for themselves in the market, right. And so cost would be a metric that they would track, but I wouldn't put I mean, I would not advise these guys to go with cost as a KPI at this point of time, because they are at a very early stage. However, if this company was a company that has been in operation for 20-25 years, then cost of manufacturing and WIP costs, etc., all of these would start figuring as KPIs, because as we will see further, right, I mean, KPIs are an evolving thing. It's not stationary. It's not like the KPIs that you have or were applicable for your business at the start of your business or in the first few years will be the same KPIs that will take you forward. So does that answer your question kind of, David?
Yep, it does. And I think we have a question in the chat.
Yes. So there are a couple of questions. So Muhammad Aslam is asking if employee turn rate would be a KPI. I mean, I am assuming that's your question, Aslam. Answer is absolutely yes. In fact, it's one of the must-track KPIs for any organization, if you ask me. All right. And then there is another question, which is customer churn rate. So what is customer churn rate? So customer churn rate, I'm glad you asked that. Customer churn rate is the rate at which you are losing customers. Okay. How do we calculate it? All right. So based on your business and the kind of products that you sell, you can define your customer churn rate over a month or a quarter or a year, right? Or all three, actually, right? In fact, I mean, I would advise to track it over a month, quarter, and year as well, so that you have a good comparison and you can then kind of get rid of any skewed effects that might come in because of one particular month or quarter or whatever, right? So take a look at all three numbers. But how you calculate it is the number of customers lost over a period divided by average number of customers, all right, multiplied by 100. I mean, that's it. I mean, that's the customer churn rate, and it is telling you for that how many customers you can expect to lose. It does not mean that you will lose that customer, right? I mean, it does not mean that I mean, it's not a predictive KPI. It just tells you what has happened, that you have lost so many customers over an average of the customers that you have in a particular period. This period could be a month, it could be a year, it could be a quarter. Most SaaS companies track customer churn rate per month, all right, because usually they have monthly subscriptions. And typically it would be, I mean, one good measure of your churn rate is every time is, churn rate over your billing cycle. So if your billing cycle is 3 months, then you should definitely be looking at that. Your churn rate over 3 months. If your billing cycle is every 6 months, then you should be looking at your churn rate every 6 months, and so on. Because it is from one billing cycle to another that the churn really shows up, right? I mean, customers have, because people will usually leave, especially if your billing cycle is longer, when they have to pay the money later on. And that is when you will get the true nature of your customer churn rate. So I hope that answers your question. And how do you set KPI for a new manufacturing unit? All right. So depends on what you manufacture, right? And what your immediate goals are. Okay. So if I have to set up for a new manufacturing unit, right, then first pass yield is always going to be one of the most important metrics that we will take a look at. And I have a few others that we will share with you for manufacturing units that you would typically want to track. So we will take a look at that later in the session as well. So we have a set for manufacturing KPIs out there. But I mean, right off the bat, obviously, what you would want to take a look at is your first yield pass. I mean, is that moving up or down, right? And okay, so there are another question. So Divyesh is asking MRR and ARR for SaaS companies. Absolutely. I mean, MRR and ARR. I mean, if you are SaaS, then you have to look at MRR, ARR, your LTVs, your CACs, etc. Right? And calculating MRR and ARR and ARPU and LTV and CAC, etc. is pretty. I mean, these are some of the key metrics that you have to track, right? In addition to customer churn rate, because for SaaS, I mean, your lifetime of a customer is determined by your customer churn rate. Actually, how it works is that if your churn rate is, let's say, 1%, right, it means that in a month, if you have 100 customers, then you are losing one customer, correct? And that is your average churn rate based on your historical data or whatever, right? I mean, that is what it averages out to. So if your churn rate is 1%, then you're losing that one customer out of 100 every month, which means that if you don't add any new customers, right, then over a period of 100 months, right, you will end up losing all your customers, correct? And the customer who has signed up for you today will then be with you for a period of 100 months, correct? So that's basically ends up determining your lifetime of a customer. Lifetime is basically 1 upon churn rate for for any organization. So once you know the lifetime, then you can calculate the lifetime value, which is determined by your average revenue per user multiplied by the total customer lifetime, right? So and then, I mean, obviously you look at this every month, you look at this every year, and then you have your recurring rates, which is MRRs and ARRs. Okay, so you would get those numbers as well. Now, one mistake that I have seen SaaS companies doing when they are calculating ARR and MRR is including fixed costs in their MRRs and ARRs. We should not do that ideally. Why? Because fixed costs are by definition not recurring costs. So, for example, if you're setting up an accounting system, for somebody, right, like Deskera, then if the client or the user wants one-time training or some kind of a configuration or professional services, right, then it goes ahead and is provided to them for a fee, and then that fee is not your recurring revenue. So you should not include that as part of your ARRs or MRRs at any point of time. Only whatever your subscription fees or whatever that you are going to make per month. Okay. Then what should be the right KPI for a marketing team or even an agency? So for a marketing team, right, the KPIs that you would want to look at typically are leads being generated per month. But I mean, actually, I would not. I mean, again, it depends on at what stage you are. If you're just starting off your business, then you're happy to generate leads, right? And as long as you are able to generate leads and get them over to the sales team, then that's a good KPI to track in the beginning. But as your organization evolves, as your team matures, right, you would you should ideally be looking at leads being closed per month. Now, obviously, there is always that uh, fight between sales and marketing. That marketing will say that sales did not close the leads, it's not my fault, and sales will say that I cannot close the leads because marketing did not give me good leads, they gave me bad leads, right? So there is always that conflict between sales and marketing at some point of time. That is resolvable, and we will be talking about that as well. So yeah, we will be coming back to that. Then there are a couple of other questions. Let's go through that. So how many KPIs should be ideal in an organization? Uh, there is no scientific answer to it. It's all empirical, right? Uh, it depends on what you're trying to achieve. But ideally, I would. For example, Apple has got 27 KPIs that they track just for their suppliers, right? There are 27 KPIs that they track their suppliers on, that they measure their suppliers on. Uh, but again, I mean, the scale at which at which Apple operates is completely different, and they have a business model where there is a lot of manufacturing going on at the supplier end, and they need to maintain a lot of quality checks and safety checks and multiple other checks, and they have got KPIs that help them do that, right? Uh, for a SaaS organization, right? Anywhere between 5 to 10 KPIs is a good number to start with. Again, depends on what you're trying to achieve, right? I mean, it is always advisable to keep it really, really simple, right? Do not uh, jump. I mean, don't start calling every metric a KPI, right? That's super important. So, if you're focused on customer acquisition only, then customer acquisition or the rate of customer acquisition is the only KPI that you should be looking at initially. Don't look at anything else. Let that be the driving factor for your organization, and align the entire operations and every process, every department around that one particular KPI. As I said, it is an evolving thing. So at some point of time, you will want to start looking at acquisition cost. You will want to start looking at other matrices as well, right? But initially, customer acquisition or building your credibility through better quality scores is what you should be looking at. Okay, so David, you want to add something to that from a from a manufacturing perspective? What are the key KPIs that one should track?
Well, it all depends, I guess, on what you're manufacturing and the different requirements based upon the manufacturing industry. Quality control is definitely can be one based upon what you're manufacturing. There are certain standards by any country, and as you're mentioning before, the what's it called? How many are manufactured and how many are rejected? You want to lower that ratio down. So that's something key. So QC checks and all that is valuable. I would also say probably delivery. And you were mentioning earlier about manufacturing the customers and all that. If you're starting out, you don't have a pool of standard customers that are buying from you all the time. For example, if you're in the construction industry and you're producing steel rebar and you're passing it off to other customers, and you don't have establishment in that marketplace, you may want to do customer acquisition. Whereas in other cases, you already may have a steady customers that are producing in that area. And based upon the type of business you're doing, there may be only so many players in that area as well. So you may also have to look at maybe different locations, different ways you're quantifying it as based upon that. Because if there's only 10 players in town and they're all your customer, then there's no point. You've been there long enough. You don't really need to look at customer acquisition. Then you can look at default, deliver in full and on time. You can look at turnover ratio, make sure your quality's up, costs, stuff like that. It all depends on how long you've been in and what you're selling, and what are the statutory requirements that are currently available. So basic setup KPI requirements for sales of my products that I am manufacturing. I would definitely look at turnover ratio, and if based upon how long you've been in the business and the number of players, customer acquisition, and then also customer fulfillment. Are they happy with your delivery, stuff like that?
Right. So, few other metrics that few other KPIs that you would want to track at different stages of your organization, organization's maturity level, would be capacity utilization. So, especially for the manufacturing industry, right? What is your capacity utilization in terms of so one example of capacity utilization is what percentage of times my machines are active in any given day. So if your machines are actually working 6 hours out of 8 hours, then that's 6 by 8. I mean, that's one measure of capacity utilization you would want to track. Then you would want to track your equipment effectiveness as well, right? Equipment effectiveness is how is I mean it's measured by multiplying the availability of an equipment with the output and multiplying it with a quality factor, right? So all of these are ratios. So availability is how many hours a day or the that the machine is actually working or the equipment is working. The output is the number of units being produced per hour, and the quality is the number of units that are passing through the quality checks, based in that time period. So these are some of the things that you can look at.
Oh,
Let's. Yeah.
um,
David, you were saying something.
what you brought up about usage, you just brought up a memory for me. For example, a electronic or a furnace, for example, that produces steel and all that, they can't shut it off. If they shut it off, it actually costs more. The ceramic tile will break and all that stuff because when it cools down. So it has to be utilized fully all the time. So if you have machines that need to be utilized, if not, then it requires downtime, repair, and it can be like so many weeks or months or based upon that, then it'd be quite bad. So again, it all depends on the manufacturer. But that's something that just popped in my head when you mentioned that.
Right. Now, somebody asked that to give an example of a business objective and how you can set KPIs on which topic. So there are a couple of questions on that. So let's spend some time on that. All right. And I'll do it. Let's take an example. Okay. Um, of aligning the organization with an objective, right? There is an excellent example that of YouTube. All right. So, so it's an example of aligning the entire organization through measurable metrics and KPIs to one business objective. And what YouTube wanted was to increase the watch time for their users, right? Now, when YouTube started off, one of their key objective was to get users to watch more videos, and that is why they started introducing. I mean, their engineers, their product managers, everybody started tracking only the number of videos being watched, and everything that happened in YouTube at that stage was about uh, adding recommending more videos. So if you, I mean, I don't know if you have seen YouTube when it started out, but it did not have those recommended videos. It did not have those cards that would come at the end, etc. And number of videos being watched was a metric or a KPI for them, right? And that is what they kind of aligned their entire engineering, product management, everything around that. Then it shifted from uh, number of videos watched to watch time, right? Now watch time is one of the most important KPIs for YouTube, though technically they don't call it KPI, they call it OKR. All right. And there are some differences between the two, which we can which we will talk about later. But yeah, I mean, watch time is the important part for them. And how do you maintain a sticky watch? How do you maintain a sticky user base? And that is when this when the engineering team started coming up, the product team started coming up with uh, all the recommended videos right at the end of the video. Earlier you did not have that. You did not have so many cards coming up at the end of the video on the end screen. What you had was recommended videos or watch this video, etc. But to increase the stickiness of the user on the platform, they started showing more videos related to what the user was watching. Their algorithms were designed to keep the user hooked to that platform and to keep watching one video after the other and after the other. And by making it super easy for them to find videos that would interest them instead of having to search for it or go into recommended videos in the sidebar, etc., and so on. So that's an example of the entire organization aligning to a business objective, and everybody had KPIs or or OKRs being set in accordance with that particular business objective. Then Yosh is asking that can KPIs be effective for outsourcing? Absolutely. I mean, now it depends on what kind of outsourcing we are talking about here. So let's say that you're talking about outsourcing your customer support, all right? Or I don't know if you are looking at this from the perspective of somebody who's going to outsource something or somebody who's running an outsourcing business, but some KPIs would match here, right? So typically, for example, for customer support, some KPIs that you want to track are first call resolution, right? Your NPS or your CSAT, how the TAT or the turnaround time for responses, and so on. And Aslam is asking what is OKR. OKR is called objectives and key results. It's a methodology that Google follows. So they don't call it KPIs; they call it OKRs. And I mean, OKRs and KPIs tend to overlap a lot. There are some fundamental differences, right? Because you can have even certain non-measurable items as KPIs at some point of times by definition, right? Though it is never recommended to have non-measurable things as KPIs, right? But by definition, you can have some non-measurable objectives as KPIs, but an OKR is always measurable. It is always super specific. So that is the difference, a prime difference between an OKR and a KPI. So if you just Google OKR for Google or whatever, right? I mean, you will find a lot of information on what OKRs and how Google has used that. It was primarily introduced by John Doerr, who was from Intel and who was one of the early backers for Google, right? He is a big proponent of OKRs, and he was the one who introduced Google to that concept, and then they started implementing it, and they found it super useful, and they went ahead and did it. In fact, Google has got like this internal tool where everybody's OKR is set, and everybody can go and watch and see what other departments OKRs are, and all of this is a lengthy process actually. So setting up OKRs or KPIs for Google is not done in a day. I mean, obviously it's a big company, right? I mean, the scale is different. But first there is an annual meeting where they decide the overall business objectives for that particular year. So that overall business objective could be something like, okay, we have to increase market share in a particular geography, or we want to increase our ad revenue from 15% to 20%, or we want to get more clicks for ads. So it could be any of these overarching objectives that they can define, and then this trickles down at every individual level. So the salesperson would have an objective that, okay, I mean, if ad revenue is the key result area, then the sales team would have an objective built around that. The engineering team sprints will be planned to achieve that objective. The marketing team would go out and do outreach based on that particular objective to, with that messaging, to drive that message to the users and consumers and so on. And that is pretty much the technique that one should follow in every organization to set KPIs and then align the entire process. Obviously, I mean, depending on the size of the organization, it can take longer, right? For most small businesses, though, you can get this exercise done in less than a week if you're really focused about it. So let's move to the next section, which is basically KPIs versus metrics. So we saw good KPIs and bad KPIs, right? I mean, and the biggest problem that I have seen is that people tend to confuse metrics with KPIs often, and that should not happen. It's easy to confuse them because KPIs are a subset of metrics. Every KPI is a metric, but every metric is not a KPI. So make sure that your effort, your organization, your people are aligned to the KPI and not to a metric. Because as we saw in the earlier example, right, focusing only on leads but not on lead quality can misalign the marketing team from the sales team and so on. So metrics can be performance or process driven, whereas KPIs are purely business performance related, right? Now these business performances can be leading or lagging, obviously, but it is going to indicate how your company is doing, how well, are they on the right road to achieve their objectives, or are they going to miss out on it? And then decisions can be made on that. Whereas a metric just gives you information, it's a number. All right. So think of it this way, right? Let's say that I'm running a SaaS company, all right, and I have a website where people come and they sign up for a free trial, and then they go ahead and then we try to convert them into paid customers, all right. So now if you are again at an early stage and your processes are not well defined, you have not found uh, the right process to convert your leads to customers, and you are still discovering that process, discovering the right path to the right nurturing path to convert them, then what your KPI should be is to increase the incoming traffic, right? You what you want to do is you want to increase, you want to have as many people come. So why? Because if more people come to your website, if you have more page views, if you have more trial signups happening, then you have more opportunity to do A/B testing, to do some experiments, break this into different segments, try different conversion approaches with them to figure out which is the right conversion approach for you. All right. Now, once you have figured out that right conversion approach, then you would want to shift the KPI from number of page views or website visitors to conversion rate eventually. Correct. And that is how KPIs evolve. And that is what I meant by evolution of KPIs, right? And how metrics can become KPIs and KPIs can become metrics over a period of time. So going back to the presentation here, right? So some examples of a metric versus KPI that I would take for not like not exactly a very young organization, but an organization that has been around for some time. It would be, number of leads should ideally be a metric, but lead conversion rate is KPI. Now, to answer that question, right? That okay, lead quality. I mean, the quintessential age-old conflict between sales and marketing. That you gave me bad leads, and one team saying that you don't know how to close, right? So what you don't want to do is that to have one KPI for two teams. What you should have are two separate KPIs, and there are ways to measure it. So one way to measure that is that you break your conversion process into funnels. All right. Now what you're not looking at is just lead to conversion. You break this because you will have stages of adoption and nurturing. So one typical use case is that leads going to demos or free trials, and then free trials going to paid. Correct. So you don't want to just look at lead to conversion rate and then use the same KPI for your sales team and your marketing team, and then they will keep fighting each other. No, don't do that. Leads to free trials could be the conversion rate or the KPI that you want to track for your marketing team, and then trials to paid is the KPI that you would want to track for your sales team. Why? Because if somebody is signing up for a free trial, chances are that they're already interested, in your product. Correct. And that is what matters. So the marketing team has brought leads to the website, to the sign up page. Now, how many of those leads actually sign up shows the quality of leads, and it's a measure of the quality of leads. And there could be other paths here based on your nurture campaign or your nurture path, right? It could be leads that sign up for a webinar, leads that subscribe to a blog, leads that uh, you know go ahead and sign up for a free trial, leads that want to book a demo. All of these are different uh, uh, funnel stages, right? And what percentage is going through here is basically determining the quality of your lead. Then, now that we have determined the quality of the leads, then the conversion from this stage to a paid customer stage is what your sales team has to track. And if you do this, then you will hopefully be reducing the conflict between sales and marketing. So definition of qualified leads. So there is a point here from Divesh that definition of qualified leads is very subjective. That is true because, but it is subjective in terms of what kind of a business you are in. All right. Once you have established your business line, I mean, once you know your business line, which you do obviously, right? Then you have to define. You have to think about breaking the process into steps or funnels, right? It cannot just be leads or people who you call or people who end up calling you, or and then the total revenue being generated at the end of the month. If you just look at that lump sum number, right, that is your overarching objective, but I wouldn't call it a KPI, right? I mean, lead to closed is not a KPI that you would ideally want to track. You want to break it down by department, that okay, this department is responsible for getting this. Now qualification is something that is obviously subjective to the business, but in your business you would know that okay, this kind of customer converts. And if you're not sure about it at this stage of of your business, if it's not figured out, and there is absolutely no problem if you have not figured it out now, you will eventually, then your KPI should not be conversion. At this point of time, your KPI should be just trying to get as many people to the first step. And when you have a lot of people coming to the first step, then you can start using different paths to determine breakpoints in your funnel, and then use that as individual KPIs for your sales and marketing and so on. So don't let your business be driven by sales when you don't know how to close sales at this point of time, right? Once you have that figured out, then you start breaking down or talking about qualified leads. That is the right time to start putting those KPIs in place. So, David, what are your observations on KPIs and metrics? Anything that you would want to share? Any observations or any experiences that you have had?
Oh, I've seen several companies. You were talking about alignment through marketing and sales, where they come into conflict and stuff like that. And I was mentioning earlier about fulfillment and delivery and cutting costs. It's important, I always see, from depending on which company you're in, that everyone's aligned on the same page. But there are some places where, what's it called? Some people forget about certain departments in certain areas. For example, like human resources or HR. They may have a different type of KPI, retention rate, stuff like that, that does not affect with sales or anything like this, but if you think about it, retraining a person, requalifying can have effects on that as well. But so, and measurement, for example, if I'm thinking HR, are the employees happy? My measurement, is everybody smiling? Yes, everybody's smiling. So therefore we qualify. Everyone's happy. Not smiling in fear that they're going to get fired by the crazy person. It's all depending on the measurements and what you're measuring for the KPI. So, for example, you're looking at percentage. You have these, what's it called? Maybe surveys once a year, and then from these surveys, you can determine a certain percentage of how the employees feel and their ratio on it. It has to be, it's just, example is that what's your measurement? You have to make sure it's a good measurement in that aspect. Like you're mentioning number of leads, like, yes, I have 5 million leads every month, but I convert 2. Well, that's not really good, So you have to always look at, what you're measuring, how you're measuring it, and how it's going to affect your overall KPI in the end. So that was what I was thinking.
All right. Thanks, David. So let's move to the next topic now that we have a fair understanding of what are KPIs and what are metrics and how they're different, right? Let's move to the next topic, which is leading versus lagging indicators. So, okay, before I jump into this, uh, David, what do you? I mean, when you hear the terms leading and lagging indicators, what comes to your mind?
Well, I always think of it like, well, when I hear leading, I always think of like the, what's it called? Usain Bolt. Usain Bolt's in the lead. So going forward in the future, something that's going to happen, maybe we have a leading indicator, and lagging indicator, something that's in the past, maybe something that's already happened that you want to check and analyze. So, for example, this webinar, maybe a lagging indicator would be how many people attended, how many people commented, stuff like that. Leading indicator, how many people are going to sign up in the future? I'm not sure. This is what I'm thinking off the top of my head, something like that. What do you think?
So, leading and lagging is essentially, tracking cause and effect, right? Or inputs and outcomes. So, to have any output or any result, right, you need to do certain things. And leading indicators are uh, leading indicators or leading KPIs are KPIs that measure the input side of things, right? It is the effort that is being measured here. And then lagging indicators are the actual outcomes that you are measuring. Okay. And you have to align these two. Typically what happens is that leading indicators are KPIs that you would align with personnels or departments, and lagging indicators are what you would align with the organization, and it comes through together. Okay. So if let's say that your overarching business objective is to increase sales, then how to achieve more sales? How will you know that you are achieving more sales? And what to achieve is basically answering the question that how much should my sales be, right? If answering these two questions will give you your insight into leading indicators and lagging indicators. Take an example, right? Uh, the KPI that I want to track is conversion rate. And my objective is that I want to improve my conversion rate from 20% to 30%, let's say. Okay. So, conversion rate is my lagging KPI. Why? It is the end result of a lot of things that have happened before that. Marketing has worked, sales has worked, product team has worked, support team has worked. All of them have worked together to to get the customer to come to your website, to sign up for a free trial, to or to call your sales team and book an order. You know, so many things have happened before that to come to that conversion rate number. And this conversion rate number is the effect of everything that has happened. It is the outcome that you're tracking, right? It is what you have achieved. So it is a lagging KPI. Okay. Leading KPIs would be uh, website visitors that convert to free trial, right? The first stage of your funnel, for example, that conversion rate, that would be a leading indicator. And you can go even further down here. I mean, it's up to you. I mean, depending on the complexity of your business, you can keep going down, or depending on the organizational hierarchy, you can keep going down at each level to define what are leading and lagging indicators for each step. There is this concept called SIPOC, actually. It's supplier, input, process, output, customer, right? So SIPOC is something that you create for every uh, step in your value stream. Okay. And for each step, you have to determine where the inputs are coming from, where the outputs are going, and who is consuming them. So the C here does not stand for your end customer. It stands for the next person in the value stream who's consuming whatever that is being produced as an output for a particular process. And then once you have this mapping in your value stream, then you are able to identify leading and lagging indicators for each step of your process. And the further down you go, the more detailed information you will have. My recommendation: don't go too deep down. Try to keep it to maybe one or two levels from the business objective, because things can get super complicated and super messy real soon if we are not careful. It's very tempting to go in that world, where we are tracking thousands of numbers and the dashboard has got 50 graphs flashing around. But it creates more confusion in my experience than what it resolves. So please keep that in mind. Okay. uh, So yeah, I mean, one point that I've written here is that they are harder. I mean, leading indicators are harder to measure because they are more dynamic in nature, and however, they're easier to control. So there is this yin yang kind of a thing going on between leading and lagging, right? Lagging indicators are very easy to measure, which is why most organizations would focus more. I mean, when they define KPIs, they focus more on lagging indicators because that's the end result, that's the output, that's there for everybody to see, and everybody is looking at it, and therefore it's something that's clear as a sky. And I mean, end of the day, this is the amount of sales that you made. So that becomes your KPI, but that should not be your KPI, right? That should not be your KPI. It should, to create a good set of business KPIs for your organization, you should have a mix of lagging and leading indicators. Take that effort to identify the key the key leading indicators, and use that to align your employees with your lagging indicators, right? Otherwise, there is always going to be some kind of a misalignment, right? For example, I mean, for any business, sales is always, sales or conversion rate is always one of the overarching KPIs that they're tracking. But your engineering team is not aligned to that, or your product team is not aligned to that, because they are not directly involved in creating that sales number. So you have to do that SIPOC exercise and drill it down to them, and then identify what are the leading and lagging indicators for them, and then use that to predict and measure their effort and performance. So Dinesh has a point here. Dinesh is saying that, can we say that leading indicators are metrics and lagging indicators are KPIs? Uh, Not necessarily. I mean, all of them are metrics. Both leading and lagging indicators are metrics. All right. What you want to do is that when you're setting up KPIs, right, you want to set it up in such a way that you have got a mixture of leading and lagging uh, numbers in there. Why is that? Okay. If you just go with leading KPIs, right? And you don't have any lagging KPI, then you are looking at what people are doing, but you are not looking at the output. And what if, because it's not an exact science, let's remember that. I mean, this is not an exact science, it's something that you learn over a period of time by trying out different things. You can obviously look at what others have done and use that as a template, but there will be some tweaks needed. Why? Because you will have a different set of employees, you will have a different set of circumstances, geography, etc. Many variables are different. Okay, so you need to have some kind of a lagging indicator in there to make sure that the needle is moving. Because what if you have only leading indicators there? Then a lot of effort is being done, but no output is there, because you're not actually tracking the output here. So my recommendation: have a healthy mix of both. Include, I mean, again, it depends on your business, but about 60-40 of leading and lagging is good. 60-40, 70-30 is something that you should go with ideally. All right. So this is kind of answering that question, right? I mean, KPIs should be leading or lagging. David, uh, what do you have to say about this? Interesting questions. Is more of a personal preference. All right. I mean, that's how I would structure KPIs if I do it right. But uh, what you have to remember is that why are we doing this in the first place, right? Let's try to come back to that. That why do we have a mix of lagging and leading, right? Let's take an example, right? I mean, somebody, let's say, comes up with I mean, let's say that you have a brainstorming session with your marketing team, and there are like 10 ideas that have been floated around. All right. And and all 10 sounds really good, and you want to execute it. And when you execute it, then uh, you set KPIs around all these ideas and all these, and the marketing team to achieve those results. But what happens is that all of them keep on go ahead and implement these 10 ideas, but we don't see the conversion rate improving. So what was the reason here? uh, Obviously those ideas probably were good by themselves, but maybe they are not working for you at this stage because of a number of reasons, right? uh, so how do you uh, cut your losses here, because you have spent time, energy, effort, human resources, money in executing those ideas, correct? And you want to cut those losses quickly by keeping an eye on the lagging metrics here, uh, to see if the needle is moving or not. Otherwise, if you're just measuring the inputs, then there is a very serious case of everybody doing a lot of things, but nothing is actually happening at the end. Then grow big is asking if ideal KPI to be measured on daily basis or weekly or monthly. It's super subjective, right? If you are in FMCG, you may want to track it daily. All right. If you are selling, trucks, then you might want to track it over a week or a month. Depends on your business. Honestly, I mean, there is um, no right or wrong answer to it. Okay, so let's move ahead. And these are some of the KPIs that we want to track, right? So, again, this is not a comprehensive, but just a list of 10 KPIs that I feel that everybody should be tracking, all right? And they are aligned with some of the overarching goals or business objectives that any organization would have, correct? So there are financial KPIs, and there are sales, growth, customer satisfaction, and human resource KPIs. So David, when you take a look at this, what is your first feeling, or what do you feel about these KPIs? Do you think they apply to everybody, or do you think there should be more here? We can put maybe more. Any other KPIs that come to your mind that every business should be tracking?
Oh yeah, I mean, there's some really great KPIs here from what I can see. They look good. But I always see like employee turnover rate, and I'm thinking, for certain KPIs, it could also be affected based upon the process. Like I always remember that wonderful, what's it called? You get your score at the end of the year. Performance. Yes, did I perform well and all that? And there's other people that base this on a bell curve. They have a wonderful bell curve there, and they say, okay, top 10%, whoever you are, fail. I mean, succeed, A plus, bottom 10%, fail. Sorry, And, you have to look in your processes as well. I guess that's why it's called key process indicator. But what processes you're using can determine certain things. Like if you're failing always the 10% of your company, or 5% or 3% or whatever it is based upon the process, then your employee turnover rate may be affected by that. So if you're looking at, I want zero turnover, but I'm failing everyone every year, no matter what they do. If they're in the bottom 3%, they're failing, then of course you may expect some turnover. Whereas some other ones here, you can look at, like average days account received, net cash flow, gross profit and loss margin. These are financial KPIs, which are very, very good. But And you can have other KPIs as well, like average return per user, conversion rates. And, I see financial, sales growth, customer satisfaction. I would guess you would have, some performance. So, what's it called? Like we were talking about earlier about manufacturing, the rate of number of products that are able to be manufactured for the first go and how many are actually rejected and stuff like that. So, it all depends. Customer churn rate. Oops, sorry about that. I clicked the button. All right. What's it called? Customer acquisition rate. So I guess it really depends on the business. Yeah. So for financial, sales, growth, these are some great KPIs, but I guess depending on your business, you have to get more industry specific, right?
Yeah. And just want to talk about some of the KPIs in here. Okay, so some interesting anecdotes about KPIs as well that come to my mind when I look at this list. Everybody knows Amazon, right? Everybody has heard of Jeff Bezos. So there was, during the early years of Amazon and up to, not, I would say about 5-8 years ago, right? Amazon was always in red. So their profit was always, they were never in profit. They were always in loss, correct? But Amazon kept expanding, kept growing. And why was that? Because Jeff Bezos was completely focused on one financial metric on his, in his books, and that was net cash flow. That was his North Star. That, okay, my cash flow has to be good. My cash flow has to be positive. I should have money coming in. All right. As long as I have money in the bank, I can spend more of it to grow faster. And that was what they were looking at, right? And they were not looking at profit and loss as a KPI. If they were looking at that as a KPI, then the organization would have been working towards optimizing that. But Amazon did not do that. Amazon never thought of profit and loss as a KPI. They always thought of net cash flow as a KPI. Obviously, depending on what kind of a business you are in and what stage your business is in, you will want to look at profit and loss. And I wouldn't say that to ignore it completely, but it always pays to have one North Star, one objective for a particular segment, that you want to align your uh, entire organization around. And Amazon did that really well with net cash flow. Similarly, YouTube did that with watch time, right? First, number of videos being watched per user, and then secondly, the watch time per user, right? These are simple KPIs which are pretty straightforward, and they kind of set the tone for everything you do. So if you have one or two overarching KPIs here at the organization level, then it helps you to align everybody along that path and just focus on that. Don't focus on something that is not doing so well. There are so many metrics, so many numbers. Some will go up, some will go down. Don't worry about that. Focus on what is more important for your business at this point of time. Okay. Now, another thing is the LTV to CAC ratio, right? You see that there, and I call it, I've put it into growth KPIs, right? Why growth KPIs? Because measurement of these three KPIs tells you whether you're growing or not and how fast you're growing. Okay, LTV, as we remember, is basically customer lifetime value, which is uh, your average revenue per user multiplied by your lifetime, or basically average revenue per user divided by customer churn rate. Okay, and that is your LTV. And CAC is customer acquisition cost. Now, customer acquisition cost is something that can be tricky to calculate if you are not using books, or if you have got some complicated processes in place. But we need to be clear about what it is. It is about direct costs that go into acquiring a customer. All right, so it is not indirect costs. Let's take an example, right? So for every customer, every single customer that you are acquiring today, right? Let's say you have a company that employs 10 people, and it spent $100 in advertisement, and it is paying $10,000 in salaries, and there are other expenses and all of that, right? All of this eventually is being spent to acquire that one customer in a month, let's say. All right. then the customer acquisition cost is not the sum of everything here. It's not the sum of all the salaries that you're paying. It's not the sum of the rent and the expenses and the electricity bill and the stationery and everything else. No, it is not, you would put as or classify as CAC. What you would be doing is looking at the direct cost that is spent in acquisition of the customer. So in this case, advertisement costs. That is what you would look at as your CAC. Some companies put the salaries of the marketing department there. Some companies put the discounts that they have given under CAC as well, and so on. Again, there are different accounting practices around that, which you can consult with your accountant to determine if they are the right thing for you. And once you have that in place, I mean, once that understanding is clear, right, then you want to look at LTV to CAC very closely. And this is not just for SaaS. Let me be very clear about that, right? It's not just for SaaS. It applies for everyone. I mean, you have to know what your LTV is, right? If you're not measuring LTV, please find a way to measure that. You can drop me, DMs on LinkedIn, etc. If you want, and I'll be happy to answer questions on how to find LTV for your business. Okay, but yeah, track LTV, track your acquisition cost, and then start looking at the ratio. Now there is a story behind this ratio. Okay, if LTV to CAC ratio is less than 1, what does that mean? That the total revenue that you are generating per customer is lesser than the acquisition cost. What does that mean? You're burning cash. And if you're burning cash, all right, then, I mean, for every sale that you're making, you are effectively going into a loss over a period of time, of course. All right. So you will eventually run out of money. That's what it means. I mean, it's as simple as that. If LTV is equal to CAC, or if that ratio is 1, then you are breaking even. So you will need, I mean, your growth is going to be super slow though. You will not be able to experience explosive growth. All right. In some industries, you cannot have an LTV to CAC more than 1 or more than 2. These are slow growing or slow moving industries in general. All right. I mean, there is not much that you can do about it, though there are a few things that you can try. For example, wholesale industry is typically one of the slowest growing industries in the world. But there are things that you can do to speed up the growth there as well, and try to move your LTV to CAC to a higher number than what it is today. And then the magic number that most people consider for LTV to CAC is 3. If you are getting LTV to CAC at a ratio of 3:1, then you will experience fast growth. You will have a set of loyal customers who will stay with you and will pay you, and you are going to be usually in the green most eventually. You may not be in the green on day 1, but over the lifetime of the customer, you are going to be in green, and you will make enough money to put back into your acquisition efforts to get more customers. So that's the magic number that you want to aim for, 3 or rather greater than 3. And if you're not there, then you might want to start looking at strategizing and make decisions and align your organization around those objectives. Increase your LTV to CAC ratio. That is the path to growth. Okay. David, any observations or any points that you want to share?
Oh, I agree. Yeah. It's important that you definitely have a good LTV CAC ratio. If not, then things get interesting, as you could say. And definitely under the KPIs and all this, it's very, very good for that. Your growth KPIs was spot on based on what you were discussing. LTV CAC ratio, customer churn rate, customer acquisition rate. How much does it cost? Are you burning cash? I was just wondering for Amazon and all that, very simply, I wonder what Jeff Bezos' LTV CAC ratio was when he originally started out selling books online. And of course, now it's probably quite high, but just curious always about that. and also specific industries. What other KPIs are added besides this for growth and for sales and financial KPIs and customer satisfaction based upon different industries as well? I think that would also depend and also change. I'm not sure. What do you think?
No, I mean, yeah, you are right about this, right? I mean, and LTV to CAC was pretty good always for Amazon, which is why they're here. I mean, which is why they're here today. All right, they have. I mean, we keep buying things from Amazon. I mean, in this room, whoever is sitting there, we have bought items multiple times from Amazon, and Amazon is tracking that. Amazon knows how much money they have made from each customer and how much they can expect to make based on their previous buying patterns and history and whatnot. So there are algorithms, and their CRM is going to, be telling them that, and that is why you should be tracking all of this. I mean, you should be putting all of this in your CRM, right? And then you should be tracking the revenue being generated for each customer, which you would eventually get through your invoicing and accounting and CRM being combined together, right? So you can actually track all of this quite easily with Deskera, in fact, because we are integrated business software. You have got accounting also, you've got finance also, you've got CRM also, you've got e-commerce also. So multiple things are there together, right? So yeah, I mean, it's easy to track that.
Actually, I'd like to know about this one.
Which one?
Can LTV is possible for HR role for employees? So can an employees be tracked LTV based upon his salary and stuff? Is he making you money? Should we be fired? Is he just a use? I mean, is this possible?
No, lifetime value by definition is the money that you're making from the customer. All right. What you can track per employee is the revenue per employee being generated. Um, and you can obviously multiply that by a time period to see revenue being generated per employee per month, or revenue being generated per year, and so on. In fact, I remember when I was with Accenture, we used to see I believe that this was one of the metrics or KPIs being tracked by the senior management back then. I'm talking about like 2007, 2008, and so on, right? Because we used to get these reports where we used to see that what the revenue per employee was, and that was something that was being published internally to Accenture employees back then. So that's a very common way to track the money that you're making per employee. Again, it boils down to whether those employees are working as a cost center, or in a delivery center, or in a revenue generating center, right? So you would typically want to track revenue per employee for your sales team, for your marketing team. You wouldn't want to track revenue per employee for your engineering team, maybe. Though, I mean, it's obviously possible to do that. And there are companies that do that, and they do it well as well. And it kind of helps you to decide, okay, this product is making more money, so you want to invest more resources here. And then, if you have multiple products, right, and you are seeing more revenue per employee for a particular product, then you obviously want to push that more, and you want to make that product even better, right? And that's how those decisions are taken, which is where KPIs play their part as a decision making tool for your organization. And that applies to everything. That applies to HR, that applies to sales, marketing, every function.
I remember back in my implementation days, they were tracking a KPI of how much time a consultant spent on the bench, meaning not in a project, and I guess not earning a revenue. So that was something that I remember them tracking back when I was doing implementations. Once you complete implementation, how much time you spend on the bench until your next implementation. If you're in a long-term project where you're doing support, how much enhancements are you doing? What type of changes you're doing to the system? How are you streamlining the system, making it simple? Stuff like that. But that's back in the olden days, long time ago.
Right. And so there's a question here from Dhruv. what is churn ratio? So I believe you're referring to the customer churn rate or the customer churn ratio, and that is the rate at which you are losing customers. So uh, let's say that you lost 2 customers in a month and you had 10 customers at the start of the month and you ended up with 20 customers at the end of the month, then there are again a couple of ways to calculate this. You can take 2 divided by the average number of customers in the month, which is the start plus end, divided by 2, which will be 2 by 15 in this case. Or if you want to go for a more conservative approach, then you look at customers lost from the customers that you had at the start of the month or at the end of the month. Basically, pick any one point in time or just take an average, and that will give you the average customers that you want to use as the denominator, and then the number of customers lost is what you have. I mean, you already have that historical number, so you just put that on top and you get your customer churn ratio. And this is what leads you to your customer lifetime calculation as well. Typically, your lifetime is equal to 1 upon customer churn. Then here's a question from Grow Big. Can we change or reset the KPI number once it is communicated due to some practical difficulties? And what is the ideal time to set the KPI? See, absolutely. I mean, because things and circumstances can change, right? I mean, there are black swan events that have happened in our lifetime, right? We all saw COVID come out of nowhere, and it kind of changed everything. And whatever that you were doing before, you have to adapt quickly. And if the situation needs it, then you have an obligation to change the way that you are running your business. You have to adapt to survive. It's as simple as that. Whatever that needs to be done has to be done. And if that means changing the KPIs for your business, for your employees, so be it. Obviously, it has to be communicated properly. It has, I mean, you have to have the proper reasoning. You need to have the communication done properly. If the messaging is not done right, if all of a sudden I wake up one day and my boss tells me, hey, today you're going to be measured on this, I'm not going to be happy about that. But if that explanation is provided, why are we doing what we are doing, and that messaging is done right, then absolutely no reason why it cannot be done. End of the day, the purpose of the KPI is to drive decision making, to drive the business forward. It is not to hold the business back. Always remember that KPIs exist for the business. The business doesn't exist for the KPIs. All right. So let's move ahead. David, would you like to take us through some of these KPIs, which are some industry specific KPIs here?
Oh, yeah. I'm muted again. I apologize. So now, can everyone hear me now? Okay. So we have, of course, wholesale and reseller. So number of returns per supplier, which is good because, you know, you want to have a ratio there. You want to have a number that you're returning. And based upon that, you want to have as little as possible returns per supplier. It reminded me of this story, actually, back in the day where there was a company that placed an order and they had a percentage of how many could be defective to the supplier. And the supplier didn't understand that, so they produced the total amount of goods plus defective goods to them as well, because they said, oh, you said you wanted this many defective and this many goods, and sent it off to them. So always remember that one. But, you know, that one's good to know. Average order fulfillment time, how long does it take to fulfill? Which is good because it'll affect your lead time, KPIs, how much are you doing a warehouse, how much time it sits in. That way you can have enough safety stock. You can time how much lead time you need. So yeah, inventory turnover ratio, stock aging. Yes, definitely stock aging. I guess for that, you'd have a KPI of how long, minimum or maximum, and you would determine that. We have a whole webinar on this that Sarva's done. So definitely check that out on that for the turnover ratio and stock aging and all the inventory one. E-commerce number of website visitors, yeah. Current abandonment rate. Yes, how many are abandoning on all that percentages? Manufacturing. Yes, yes. Equipment effectiveness, availability X, output X, and quantity X. Capacity utilization, first pass utilized. I guess for manufacturing, you would have to also use this as we were discussed earlier, based upon what type of business you are. You're a small business, just starting out. Are you established business? And what you're focusing on. You're focusing on sales. You're focusing on customer acquisition. Are you focusing on quality? And then you can look at, of course, always first pass yield. You don't want anything rejected, but utilization and equipment effectiveness. Does that affect your ability to acquire customers, and will that affect your ability? So I guess a combination. And of course, when I see service industry, you're mentioning about black swan events or force majeure, and with COVID and all that, number of billable hours per client, number of restable customers, CSAT score. Of course, with the great shutdown that happened when they told us all no going to the restaurants anymore, of course, some of this would have to be changed. You would have to take in, instead of how many customers are coming into the restaurant, the number there, to the number of orders and deliveries that are going out of the restaurant. How much are you actually selling outside? So, and referenceable customers, do you have the information? Because before the black swan event, COVID and all that wonderful stuff happened, you would actually know how many customers are coming in and that information. But based upon when you're going out, systems change. Like you have Deliveroo, Food Panda, these other companies, and they might not provide you the customer data. So you may also be at a disadvantage without knowing the information. You just may know how many deliveries there are, but the actual number of specific referenceable customers may be different. This is something that I'm seeing here. I'm just thinking about. I'm not sure. What do you think?
Yeah. So there are certain KPIs that every business should be tracking, and we kind of took a look at them in the earlier slides. But yes, I mean, for your industry, these are just some examples. You may not be from this industry. You may be from a completely different industry. But yeah, I mean, just some examples that in addition to the overarching KPIs that you have, right? You want to look at certain specific items. Now, these KPIs are not all of them are going to be organization specific, right? They are what you would arrive at through your process mapping and value stream mapping, and then doing the SIPOC at every stage or whatever, and then kind of arriving at some of these metrics for different departments, right? Obviously, I mean, you won't have first pass yield as a metric for your sales team, right? It doesn't make sense, right? For industry, there are going to be certain metrics that you will have to assign to different departments, to different individuals, to different functions, and the process is again going to be the same, that you look at your overarching KPIs, your overarching, what's your North Star, then that North Star is what you would break down into key functions like financial, sales, CSAT, customer satisfaction and employee KPIs and so on, and then start breaking that down into departmental KPIs individually to create a map of KPIs at individual level, department level, organization level, and so on. And that is the whole idea behind following this exercise. So with that, let's move to the next section, which is KPI examples for some of the fastest growing companies in the world, all right, or some of the biggest companies in the world. And we talked about Google earlier, right? Google doesn't use KPIs; they use OKRs. So they won't call it KPIs. There is some distinction between the two, but all KPIs are OKRs, right? Not all OKRs are KPIs. So, sorry, not all OKRs are KPIs and all KPIs are not OKRs, right? Correct. So, OKRs are always measurable, very result oriented, whereas KPIs can, in some cases, be non-measurable. Okay, I mean, there are examples, right? I mean, for example, you might want to put increased teamwork as a KPI. I mean, I have seen that happen, and it's okay. I mean, it's okay if it helps you drive a certain performance for an employee or for a team, right? But I mean, you cannot really measure that KPI, right? Trace together. So, can we have the slide slightly bigger, please? Thank you. So, Stripe tracks disputes and frauds that happen across its payment engine. It's important for them because they are a payment engine, right? I mean, they're a payment gateway. So, any kind of disputes and frauds are happening, they want to keep track of it by merchant, by the seller, by the payee, by the merchant. Uh, Across geographies, they are always tracking these trends across different uh, uh, nationalities and geographies and so on, to decide. And how many disputes and frauds are happening is something that drives their engineering team to fix issues or to add more compliances or more regulations in place, right? Similarly, they're tracking the number of refunds. Is it because of fraudulent activities? Maybe somebody's adding cards incorrectly, or maybe somebody's charging cards incorrectly. So these are some of the key metrics or KPIs that Stripe tracks, right? Then Apple, as I said, I mean, they have 27 KPIs just for suppliers. I mean, they operate on a different scale, right? Most of their supplier KPIs, for example, are around safety and quality primarily, but it's also about. They also have KPIs on employee welfare. That the people who are working for their uh, suppliers have to follow a certain standard, and I mean, there's a document on that. I'll put that link later on in the description. But yeah, there are like 27 or 28 KPIs that they track just for the suppliers, and then they have got KPIs for every specific department. And all of this is around, obviously, the main KPI, which is capturing as much of the smartphone market share uh, and basically capturing more market share. Netflix is all on hours watched and customer retention. So once you have signed up to Netflix, you want they are tracking the retention numbers, and they're tracking how many hours every user has watched and what are the total number of hours being watched on Netflix, right? And Google is again like Google, sorry, Alphabet, right? I mean, they have KPIs or OKRs for every single thing that they have in that umbrella, in the Alphabet umbrella. Uh, YouTube's example is what we saw earlier, which is basically watch time. And I believe, I mean, though it's not official, but I'm pretty sure they are tracking premium conversion rate right now. Because if you open YouTube, that's the first thing that you see: convert to premium, convert to premium, convert to premium. I mean, why is that happening now? Why was it not happening 1 year ago? I can bet that it is a KPI that they're tracking now, though, or an OKR. How many? I mean, their OKR would be something like 1 million premium users in a month, right? Something like that. So yeah, I mean, that's one difference between OKR and KPI. OKRs are also goals. KPIs are not always goals. All right, KPIs are measures which tell you whether you are on the path to achieve your goal or not. They're indicators, performance indicators. OKRs are always goals, right? X million users subscribed, Y million minutes of watch time achieved. That's what an OKR would look like. This can also be a KPI, but the KPI will be slightly different here, that minutes watched, right? Or uh, premium users per month subscribed, something like that. So that's one difference between KPIs and OKR, since we are on that topic. Right. David, anything that you want to add?
Oh, nothing really. It's just always the safety KPI I always find is an interesting KPI because it all depends on different sites, different locations, what you're manufacturing from. For example, you may have people doing stop audits going around the site. They may have to do 5, 10 stop audits per week or per month based upon their job requirements, and you may have other employees doing it as well, logging it in for unsafe areas and making sure. And then you have a KPI on once a stop audit was done, the log, how long it'll take for them to resolve it, what barriers are taken into place to make sure anyone's safe and they don't actually harm themselves, these type of things. For example, I always think your KPI has to be something like this. It can't just be nobody dies. You know what I mean? And well, of course, you don't want anybody to die, but you're not actually trying to protect everything, like 100% use of PPE. What barricades are you doing? What type of stop audits you're doing in order to make sure everything is safe and secure? Where are you blocking certain areas? For example, is there a giant pot pit of water with no barricades and people are jumping over it for fun? Maybe you should stop it and barricade it and make sure everyone stays safe, stuff like that. And, you know, what ratio should it be and all that. Again, it depends on which company, what manufacturing you're in. And you always see that in different areas and different locations.
Yeah, I mean, that's point that you mentioned, David, about safety KPIs, right? Safety KPIs is one area where you don't want to track lagging KPIs. You want to track leading KPIs only, because you don't want to track number of accidents happen ideally. I mean, once an accident has happened, chances are that it's already game over. So this is where you want to drive performance by tracking all the leading KPIs. The good thing is that in safety, for example, or wherever there is any kind of standardization required, right? This is where all these standardizations like ISO and all of these, they come into play. Wherever the outcome is bad enough that you don't want to track it or you want to keep it to zero, right? Usually you would have some kind of a standardized approach around building that. And in such cases, you want to track your leading KPIs only. You don't want to track your lagging KPIs, right? So mostly all safety KPIs that you would come across are leading KPIs, because I mean, there's no fun in tracking deaths per month, right? You don't want to do that. What you would ideally be tracking is what steps you are taking to prevent that from happening. And so this is a prime example of where you don't want to track lagging indicators. You want to track leading indicators only. But it helps here because you will normally have a well documented, standardized process around this, something that has been well and truly established in in more cases than not. Okay, so with that, we are at the end of our session today. Hope you had a good time. We'll wait for some time to see if there are any other questions that you might have, any last minute questions or etc. You can always just ping me on LinkedIn or DM me on LinkedIn if you have any questions about how to use KPIs or about running your business and so on. There was one question actually earlier that I saw, which I think we missed. Is Deskera planning to add KPI tracking feature? So we already have something that can help you do that. We have a report builder as part of the ecosystem as part of the Deskera ecosystem, and you have all these data sources in Deskera, right? I mean, you have your financial data here, you have your inventory data here, you have your sales data here, you have your purchase data, customer data, bank data, payment data, employee data, expenses data, claims data, leave data, attendance data, everything is in one place. And you have a report builder that can use all these data sources to get all the points together and then create a customized dashboard for you. So you can create a customized KPI dashboard for yourself using the Deskera report builder. And that is where we want to go with, right? Which is basically to enable you to get all data from reliable data sources, which in this case is your data residing in Deskera. And then you have that all available in one place to put together from different data sources, from different departments, functions, etc., to get your KPIs updated in real time in front of you on your dashboard. That's where Deskera comes into play. So there is a question, please explain LTV again. Sure. So LTV is lifetime value of a customer. So what do we mean by lifetime value? All right. Now, this is easier to measure if, let's say, you have a subscription model of business. Okay. So, um, let's say that you sign up a customer in January, and then that person remains your customer for the next 6 months, and every month you are generating $50 from them. So that particular customer's lifetime value is $300. All right. $50 for 6 months, so $300. Okay. Obviously, when a customer signs up, you cannot predict how long that person is going to be with you, right? We all want the customers to be with us for their entire lifetime. I mean, that's the goal, that's the dream, right? But we cannot predict that, okay, this customer is going to be my customer for the next 20 years. Nobody can predict that. And if you do that, then you may end up with some very bad decision making, right, based on those numbers. So how do you then predict or try to get a measure of how long a person is going to stay with you? And that is where your lifetime calculation comes into play, right? Now, how long a person is going to stay with you is the probability that you are going to calculate. I mean, not the probability, but rather you calculate it based on your churn rate then. All right. You know your churn rate because you have had customers. I mean, if you have been running your business for a few months or a couple of years, then you have the data with you, which tells you what your actual churn rate is. You can get your churn rate over your billing cycle, right? Typically, let's say if the billing cycle is a month, then what you're looking at is a monthly customer churn rate. And the churn rate is basically number of customers that leave divided by average number of customers in that month. Though there are other methods, like as I mentioned, you can also calculate based on number at the beginning of the month or number at the end of the month. Again, something that you can decide, and it depends on the business, honestly, right? I have seen a lot of people use average. So number of customers lost divided by average customers in that month, right, is what you uh, look at for your churn rate. That means that on an average, in 1 month, this is the probability or number of people who are losing out. So if you are not adding any customers, then any one customer who is here will definitely be out by the end of your period, right? So let's look at it from a numbers perspective, all right? Let's say your churn rate is 1%, and you have 100 customers at this point of time. So the probability of any one person, right, leaving is uh, 1 out of 100 in any given month. But not all customers are leaving, right? Again, in some months it can be higher, in some months it can be lower, but that's the average that we are looking at. Okay. So over a period of 100 months, you will eventually end up with no customers gradually, more or less, right? Because you're losing one customer every month. But any one customer who has signed up today, the chances of that customer leaving each month is only 1%. But at the end of the 100-month period, that person is definitely out of your system. Correct. So you can predict in this case that this customer is going to be with me for a period of close to 100 months or 8 years. So that becomes your lifetime for that customer. And if your average billing revenue per billing cycle is X, then this lifetime multiplied by X is your lifetime value from that customer. We have actually a blog on this with calculations that explains it in detail. Maybe I can flash the actual link. Sumesh, you can find the link on deskera.com/box/SaaS-KPIs. I think that's the link. But just double check, and we can flash that on the screen as well. Can you provide few KPI reports for manufacturing? Um, are you are you talking about it from the Deskera perspective or as templates? Um, if you could just clarify that part, then I'll be able to provide an answer for you. We will be putting up a blog post soon on manufacturing KPIs, and that will contain some template reports which you can definitely go ahead and download. So if you have not, then please subscribe to our blog as well, because wherever we have new posts coming up, then we update all the subscribers on it, and just make sure you are not missing out on some great guides and templates and presentations that we already have there on the blog. There's a lot of resource on our blog. If you have not seen it, please go ahead and take a look. But yeah, I mean, we have done a lot of detailed explanations everywhere. So you might want to take a look at that and subscribe to it. Templates. Okay. So so as I said, we will be doing a manufacturing KPI post in the coming weeks, and you can expect to get some templates there that you will be able to use for your business. Right. Then there is a question from Dhruv. What are some good KPIs for an agri-tech startup, which is into production of vegetables as well as direct and retail sales? So what you should be looking at definitely is your turnover, your day sales of inventory, right? Day sales of inventory and turnover ratios. I mean, because you are managing inventory and your inventory is perishable inventory, all right. So it's important to uh, track that real close, because if you're not, then very soon you may end up with a warehouse full of rotten food and there's nothing to do about it. Correct. So uh, so day sales, inventory turnover ratio, you might want to look at your reorder points and reorder levels, and you might want to keep a vendor scorecard actually, or a supplier scorecard, for which people are sending you better quality stuff and not. um, Lead times are not so important here, because again, this is perishable goods, so you will typically be, when I am assuming that it's not going to take months or half a year to ship stuff around. Obviously, I mean, you can DM me more details about the business and I can provide more inputs, but based on I mean, these are my first impressions. David, what do you think? Any ideas on what kind of KPIs for an agri-tech startup?
Well, definitely quality, and definitely based upon different countries' statutory compliance, depending on where you're actually shipping the goods. For example, I always remember flying into California. I would buy these wonderful, beautiful orchids for my good old grandmother. We fly into California, and the wonderful lady would take the orchids and wham, 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 and check if there's any bugs there, because they're very, very strong and restrictive on any type of bugs or any type of living things on there, because they had, I believe it was, what was it? Was it the Tokyo beetle that came on over and wiped out all of the crops in California or something like that? So depending on which country you're in, the statutory compliance, you don't want to send a bunch of products and there's a bug on it and all of a sudden your entire shipment is now null and void, And what type of perishable products? Like, well, for example, my wonderful wife loves bananas and she loves green bananas. And there's a certain period of time before they ripen, so also that type of time, but how long are you sending it to the goods? So I'm not sure if I'm helping or I'm just confusing more. But the thing is very simply that, your KPIs on your quality is important. Make sure your vendor has a high KPI quality. What type of products you're sending, where you're sending it to, are you sending it to the thing, if there's any statutory compliance KPIs that are required based upon different countries, then you also have to look at that. So those are the things I'm thinking about for agriculture. I guess if you're a farmer, which is much my wonderful wife's father does, you would have to look at electricity, water KPIs, trying to do increased efficiency, especially where she's growing crops. She's growing in Thailand in Isan province. So there's actually a limited amount of water there. So they actually had to do a giant drill. They drilled in the water. So water usage became a very important KPI, keeping track of how much is used for each crop. So sorry, I'm just going on and on.
Thanks, David. So, so just to expand on that, right? I mean, what Dhruv's asked, right? For a startup, what I would always suggest is to be laser focused on one goal or one KPI or one overarching objective, that you want to define. And typically for startups, that is either for you, if you are an agri-tech startup, what you are, you're obviously looking at expanding customers, but you're also looking at expanding your supplier network. So how many suppliers you are adding per month, how many customers you are adding per month. If you're at an early stage, then this is what you should ideally focus on, just these two: acquisition on both sides of the network. And this, if you, because if you fail in any of these two, then your platform, again, I'm not sure about your business model, but this is what I'm thinking, right? That you are creating a platform where customers can come and buy stuff, and you are going to supply them by also by both producing stuff and also acquiring it from your suppliers, which would be farmers or other folks. So you want to have a good strong base of supply, and obviously, you need to sell whatever that you are acquiring. So just these two overarching KPIs, right? And everything then is aligned towards that. Your website design, your engineers, your engineering KPIs, your marketing KPIs, everything is aligned to these two objectives: acquisition of suppliers and acquisition of customers, typically. So there are a few requests here for templates for different industries, and yes, we will be putting them up on our blog. So please make sure you subscribe to the blog, so when it is out, you get it. All right. So with that, we come to an end of this session. Thank you all for attending, and we had a great interactive session today. David, thank you so much for your inputs.
Take care. See you. Thanks again for having me.
All right, wonderful. So with that, I bid you all adieu. Do not forget to like and subscribe, and please do the needful. Uh, because we will have a lot of interesting stuff coming on this channel every week. So next week, we are going to be doing a webinar on cryptocurrency and using Bitcoin for business with OpenNode, who are one of the major players in the crypto world. And you should definitely join that. So please like and subscribe to the channel so you get the updates as and when we are going live, or as and when new content is being created, so you can watch it without the fear of missing out.